Hi, my name is Rajiv Rubello, and I'm the principal and actuary of Kova Insurance Services. In this short video, I'll be drawing on my experience on having helped manage a $4 billion life settlement portfolio to show you how life settlement providers and life settlement investors lose millions in value and unnecessary extra premiums by not fully utilizing shadow account pricing in their valuation and premium reengineering models. Life settlement investors try to determine the minimum premiums to pay on a policy using what's referred to as standard industry pricing software. However, this standard industry software only figures out the minimum premiums to pay to keep the cash value account in force, and does not determine the minimum premium to keep the shadow account in force, even though shadow accounts are often designed by actuaries to have lower premium requirements. The reason for this omission is because the shadow account mechanics are often too complicated for non-actuaries to figure out. Furthermore, most of these types of software include a buffer of premiums to cover up any potential flaws in the premium reengineering. Since the software offers no confirmation from the life insurance company that these are in fact the minimum premiums to pay on these policies, life settlement investors are forced to trust them explicitly and really have no idea of whether the premium schedules that come out of them are in fact overpaying for the policy or not. Relying solely on these unconfirmed and inaccurate premium models results in millions of dollars in unnecessary premiums and lost value for investors who should be utilizing the shadow account. So let's go ahead and look at an illustrative example to help emphasize some of these points I've been making. We're going to take a look at an 81-year-old female who has an $830,000 policy she's looking to sell on the life settlement market. She's been determined to have an 8-year life expectancy as determined by life expectancy reports. So we're going to be comparing the cumulative minimum cash value premiums to keep the policy in force as determined by industry pricing software models, and then we'll be comparing the cumulative minimum shadow account premiums, which Kova uses its actuarial expertise to help determine. So we can see here the blue line is the cumulative minimum premiums to keep the cash value account, and we can note that it's significantly higher than that of the red line, which is the cumulative minimum shadow account premiums to keep the policy in force. In fact, if this insured lives to the LE of 8 years, the life settlement investor would have spent more than $142,000 in premiums if he was paying according to the cash value premium schedule as opposed to the shadow account minimum premium schedule. As you might imagine, this has a large effect on valuation, as we'll see in the next slide. So now let's go ahead and look at the impact on valuation of using cash value account premiums that come from these industry pricing software models as opposed to the true minimum premiums that would come from shadow account optimization. So we can see here in the first row that even if the insured lives to the LE of 8 years, by using only the cash value account premiums as opposed to the true minimum premiums of the shadow account, the life settlement investor would end up spending $142,000 more on premiums. As you might imagine, this would significantly lower his return as well as his valuation ability to offer competitive prices to prospective policyholders. So we can see here that if a life settlement investor or life settlement provider is looking to purchase this policy from a policyholder and wants a 14% return, if they discount cash flows on a probabilistic basis, which looks at expected death benefit proceeds as well as expected premiums, the higher cash value premium schedule would result in a lower offer of $95,000 being able to be made to the policyholder. However, if this life settlement investor or life settlement provider were to properly minimize premiums using shadow accounts, they would be able to offer this policyholder $192,000 while still obtaining their 14% expected return. This is a nearly $100,000 difference in valuation. So as you can imagine, this has significant advantages for both life settlement providers and life settlement investors. Not only are providers able to offer more competitive prices to policyholders, but these policies, when purchased, also have lower longevity risk, because as we saw, shadow account premiums are significantly lower than that of the cash value account, especially in the later years. So the life settlement investor is getting a more safe 14% return by using the shadow account minimum premiums. Furthermore, if you're a life settlement investor in the field with a portfolio of policies, you're probably sitting on tens of millions of dollars of unrealized value because you've used cash value premium schedules in your portfolio as opposed to shadow account minimum premium schedules in your portfolio. And this is exactly what Kova does, is we help identify unrealized value and properly minimize premiums and provide confirmation from the carrier as to the accuracy of those premiums, as opposed to industry pricing software models. At Kova, we utilize our past actuarial expertise in helping the largest life settlement investor in the world save millions of dollars and benefit from unrealized value in order to help life settlement investors maximize their returns while minimizing their risk. We offer a full array of life settlement services. Kova's services include premium reengineering, which, as I mentioned, utilizes shadow account pricing, loans, and other mechanisms to fully minimize premiums. Kova then works with the carrier of the policy to validate our premiums directly from the life insurance company itself, unlike other servicers or software models that offer no confirmation of their accuracy. Kova also does policy and portfolio valuation, which uses our skill set to accurately assess the risk and measure the true value of policies. And finally, we do policy servicing to ensure that your premiums are paid on time, your death benefits are properly received, and any updates in insured health is reported directly to you. Well, that concludes our short presentation on how life settlement investors lose millions through poor premium reengineering practices. Again, my name is Rajiv Rebello. I'm the principal and actuary of Kova Insurance Services, and I founded Kova after years of experience in the life insurance and life settlement industry. My experience includes helping to manage and evaluate AIG's $4 billion life settlement portfolio of over 6,000 life settlement policies and over $18 billion in death benefit. It was here that I designed state-of-the-art reverse engineering capabilities that identified over $20 million in lost value